You've got some concerns.
Yes, I have some concerns. I'm an investor in the world. I have a lot of concerns.
Okay, John.
It's not about the little narrow. It's not about the little narrow corner of the world that you guys call private credit. It's much broader. But
seemed round up this morning.
Pardon?
Have you been annoyed by the coverage in the last few months?
No, I'm not annoyed by it. I think it reminds me of when I was a young high-yield trader in the early 90s, and when 1990, when Drexel went filed, and there was concerns about the high-yield asset class, junk bonds. You know, asset class won't survive. It's a Ponzi scheme. There's no credibility here. And I think that if I look back at that time, it was early days of the high-yield market, which is now the high-yield market and a legitimate asset class. I think this is just growing pains. And as I go back to my first principles, if investors over 15 years were not actually making money, and I see the demographics of the globe right now where investors need robust compounding yield, I'd be concerned. But I see the great benefit of this product.
I've sensed frustration. From the asset managers. You have too. I can feel it now, I've got to be honest with you. I can sense the frustration that you've got, I think, with some of the coverage over the past few months. What is it about the coverage that's been quite upsetting? The fixation on just BDCs and not the broader asset class? What is it about that's upset you and the team, maybe?
Well, I got to push back on being upset.
I can tell you over the last few minutes it's felt that way.
Okay.
Maybe not aimed directly at us, but certainly the coverage of your world.
Well, I think that a lot, because of the proliferation of the analysis in every corner of the environment we work in right now, I think that's why I had my message about taking a step back. You know, I do think when you look at the growth of the U.S. economy since '09, the result has been we have the most robust banking system in the world. We have the leading banks that are well-run organizations that have done an amazing job, and the return on equity and their impact in the U.S. economy is profound. You also have a backdrop of economic growth that is unmatched around the globe, and I don't think it's any surprise that the advent of pushing out the risk in the banking system, the benefit of securitization, the benefit of CLOs, the benefit of all the things that institutions have helped out with, that has resulted in a much broader, deeper base financing environment. We financed a lot of growth. We financed amazing tech growth. Our VC marketplace is the most robust in the world. And so I think that, you know, many mutual funds today, I'll give you a little analysis. Many mutual funds today were very forward-thinking and were able to buy SpaceX several years ago. And so SpaceX is part of their portfolio, a small portion. There's probably not a clearly defined marking process on how they all mark their SpaceX equity because of employee sales, whether it's monthly, quarterly, whatever it is. But just because the marking process may be inconsistent, that shouldn't stop them from buying a great American company that they're going to do very, very well on. And so that's why I think we're sort of missing the plot about, I've talked on this show in the past about Berkshire Hathaway, about half of their portfolio being in private companies. And so I do think the whole idea of the public-private convergence, the broader portfolio approach, where the market's going in terms of these massive CapEx, that's where I think we've sort of lost the plot a little bit. And again, I'm not in the newspaper business, but I do think that I know what sells headlines. And I think the methodical, robust growth of the U.S. economy, the role of the public-private convergence, the strength and breadth of our financing, that's really the bigger story here.